Nitin and Deepa are co-workers and investors in stock markets. However, Deepa is a more knowledgeable and active investor. Nitin asks Deepa if it is right to invest in debt funds after the changes in tax rates. Deepa told him that there are a lot of funds that can give you good returns and which have lower tax. Nitin wanted to know more about them. Deepa told him that dynamic asset allocation can be good for him. Now there is higher tax on debt funds, hence fund houses are changing their strategy. There is a lower tax on equity funds. Dynamic asset allocation funds has the option to change its allocation to increase proportion of equity and save investors from loss.
First of all, let us see what Dynamic Asset Allocation Fund (DAF) is. Dynamic Asset Allocation Fund is also called a Balanced Advantage Fund. It is a hybrid mutual fund that invests in both equity and debt instruments. According to the Association of Mutual Funds in India, AMFI, the fund manager of Balanced Advantage Fund has to manage this investment in equities and debt in a very dynamic way. Investment in equity and equity-related instruments can range from 0% to 100%, and the rest will go in debt.
So dynamic asset allocation funds, I think, bring the best of two worlds, best of equity and debt. So these are funds which invest in both debt and equity, depending on whatever their mandate is, which they announce upfront. And these can be suitable for investors who do not want the hassle of moving from equity to debt, or debt to equity. So these can be really good investment options for people who are looking at a 3-year plus horizon, where you can invest into equity and then move to debt at a particular time, but you don't want the hassle, so you're leaving this hassle to the fund manager, that they will take care of this for you. It also gives you the comfort of debt in your portfolio. So these are good for investors who are starting out their investment journey and are hesitant to put 100% of their money into equity, whether it is 500 rupees, 5,000 rupees, and they want to just start off, dip their feet into investing in mutual funds. It's a great start for them.
Keep in mind that fund houses have the flexibility to invest anywhere between 0% to 100% in equity or debt depending on the market conditions. However, most balanced advantage funds generally have an equity allocation of 65% to 100%. Fund managers have to keep a close eye on the fund and make changes between equity and debt investments based on market research and analysis, in line with investment objectives of the scheme. When stock valuations become attractive, the equity exposure is increased in these schemes, and when valuations become expensive, the equity exposure is reduced. For example, in March 2023, several balanced advantage funds have increased their allocation to stocks.
Dynamic Asset Allocation Fund managers allocate assets based on various models. Some funds invest based on the price to earnings ratio, which is the PE ratio, while others use price to book value, which is the PB value. Many funds create their own model and follow it. For example, the Quant Mutual Fund uses the VLRT framework for the money management of its Quant Dynamic Asset Allocation Fund. VLRT has 4 elements, namely valuation analytics, liquidity analytics, risk appetite analytics, and timing. Based on the chosen model and the condition of the stock market, fund managers adjust the equity or debt allocation. Dynamic asset allocation helps in reducing risk.
As per value research data, dynamic asset allocation funds have given 1.6% returns in 1 year, 17% in 3 years, 7% in 5 years, and 11% in 10 years. Speaking of taxation, mutual funds are divided into equity-oriented or non-equity-oriented funds for taxation purposes. If at least 65% of the investment in a dynamic asset allocation fund is in equity, it will be an equity-oriented fund. Such funds will levy capital gains tax of 10% on investments held for more than a year, and an investment is held for less than a year, capital gains tax of 15% is levied. In addition, long-term capital gains of less than 1 lakh rupees are tax-free. For non-equity oriented funds, if the holding period is less than 3 years, it will be considered as short-term capital gains and will be taxed as per income slab. If the holding period is more than 3 years, it will be considered as a long-term capital gains and a tax of 20% will be imposed on it. It will also benefit from indexation. In other words, before investing in DAF, you need to keep in mind the asset allocation ratio in the fund. Only then will you be able to get an idea about how tax will be imposed in the scheme.
Now the question is, what type of investors should invest in this fund? Experts say that this is an excellent fund for investors who want higher returns having medium risk appetite. The fund's dynamic asset allocation approach reduces the impact of market volatility and investors receive risk-adjusted returns.
So these are ideal for moderate risk-taking investors. So somebody who has a 3-year horizon plus but does not want to take too much risk into equity, this is an ideal category for them. But I would also go as far as to say this is also a good category of investment for conservative investors if they are aware that this brings them a certain amount of risk, especially the hybrid funds in this category which are more conservative, which have less amount of equity and more amount of debt. This could be a great start for them, for people who are moving from FDs to equity, but in a gradual manner. This is a good start for those investors as well.
Even when the market falls, these funds decline less compared to pure equity funds because of their exposure to derivatives and arbitrage. The benefit of this is that the investor's capital remains relatively secure while also receiving good returns. After changes in tax rules for debt funds, many funds have started changing their investment strategies. For example, when the Quant Dynamic Asset Allocation Fund was launched, it was said to be similar to a debt tax saving fund. However, after changes in tax rules for debt funds, Quant Mutual Fund announced that it would change its investment strategy and make it an equity fund.
Investing in a dynamic asset allocation fund can be a great way to add diversity to your portfolio. These funds offer more favorable risk-reward ratios, meaning you get higher returns than debt funds. However, as per experts, you should invest in a dynamic asset allocation fund for at least 3 years for good returns. This is because long-term investments are less affected by market fluctuations. It's important to note that these funds invest in equity, so you need to have a moderate risk appetite. Additionally, it's worth noting that fund houses are increasing their equity allocations to save taxes, but this also increases the fund's risk.